Hello there, good afternoon, and a very warm welcome to the first of our National Payroll Week special webinars, Understanding Your Payslip, a Beginner's Guide to Payroll. My name's Duncan, I'm your host and presenter today, and I am joined by my colleagues Alice, Matthew and Matt, who are all standing by in the background, ready to answer any of your questions. Now, as I just mentioned, this is one of our 5 National Payroll Week webinars celebrating the best week of the year, National Payroll Week, which started this Monday. We have a full programme of webinars this week, starting today with this session that you are already attending. Tomorrow, we are joined by our experts from Sage HR Advice to take us through navigating payroll and HR. On Thursday, we have 2 webinars for you. In the morning, Alice has taken us through keeping it real-time information, a guide to submitting payroll to HMRC, and I'll be back in the afternoon on Thursday to have a look through parental leave essentials, understanding statutory parental payments, and then to finish things off, a bit of fun, we have National Payroll Week, the quiz on Friday morning, 6th of September. Do join us for that one if you can. And if you attend 3 or more of our National Payroll Week webinars, you will qualify for our National Payroll Week digital badge that we'll be sending you out via email before the end of this month. So do join us for some of those other sessions if you can. Back to today's webinar though, this is a quick look at what I'm going to cover in the webinar, and this is a bit different to the usual webinars which are mainly focused around product demos. So we're going to be focusing more on the theory of payroll and some of the fundamentals. So I'm going to give you an introduction to the topic. We're then going to take a look at navigating payslips. So we're going to zone into each section of a typical payslip, explaining more about payments and the information that needs to appear on a payslip, deductions and how those deductions are calculated, and also other areas such as year-to-date values. We're going to finish the webinar with a quick look at the future of payslips, and the future is now. It is Sage HR online payslips that we'll be showing you in a little more detail just to finish things off, and then we'll look at all the other support resources we have available to you guys to help you on your learning journey with all things payroll. So that's our plan. Let's get cracking with our introduction to understanding your payslip. So I have done a bit of research in preparation for today's webinar. So payslips are something that have been around for longer than you might expect. And what you can see on the current slide is an image of what is apparently the world's oldest payslip. Now, if you use your imagination a bit, it doesn't look too dissimilar to a traditional payslip that you might find these days. But to give you a little bit more information on that world's oldest payslip, and I have linked to this information as well in your handout, this is actually exhibited at the British Museum. It was found in the city of Uruk in modern-day Iraq. It's a stone tablet, so made of clay, and it dates back 5,300 years. There wasn't writing back in those days. It uses cuneiform, which is a pictorial version of writing. And apparently back in those days, 5,000 years ago, people were actually paid in beer, which sounds very appealing to myself. And there are some images on that world's oldest payslip that depict beer. Apparently there are 3 of them. I struggled to spot them myself, but this is the first record of payment yet discovered. So this sort of thing has been going on a while. Payslips, also known as wage slips or itemized pay statements, are super important documents. It is kind of the one thing that connects payroll with every employee in your business, as everyone gets one every time they're paid, and getting paid, to be honest, is one of the main reasons that people come to work. So this is a typical payslip that you might find today, and this is the one that we're going to explore in more detail in the webinar today. And as you can see, it's laid out in a similar way. There's different sections for the various payments and deductions, but there is more kind of rules and regulations about how payslips need to work in the UK compared to back when we were paid in beer. So there is a page on the gov.uk website all around what should be on your payslip, and essentially a payslip must show earnings before and after any deductions, so that's your gross and net pay. The amount of deductions that may change each time you're paid. So that could be your tax, your national insurance, pension contributions, for example. And you are required to state the number of hours worked if the pay varies depending on time worked. Now, there is a note there about fixed deductions. So the information about fixed deductions can be provided as a separate written statement. That needs to be issued annually. But I would say more often than not, you would find fixed deductions as well as part of your payslip. So the idea of today's webinar is we're going to work our way around this payslip. It belongs to one of my fictional employees, Harry. We're going to look at the various zones on the payslip. So we'll be starting with payments, explaining the difference between gross and net pay. We're then going to take a closer look at deductions, and I'm going to give you an overview of how certain deductions are calculated, how that all works. And we're going to finish by taking a quick look at year-to-date values. And I've tried to add in some more fascinating facts as we go through the webinar today. So let's start our journey by taking a look at the payments area on a payslip. So these are the payments that were made to Harry last month on his August payslip. And most payments that you process through payroll are subject to tax and national insurance, and often subject to pension contributions as well. That would include fixed payments, such as a fixed salary, hourly payments, if you pay your staff based on the hours they've worked. Maybe they give you timesheets, or perhaps some of their earnings are based on the hours they've worked. That could be overtime payments. You might have variable payments, for example, commission payments based on sales that your employees might have made. And statutory payments as well can also be included when they are due for things like statutory sick pay, maternity, or paternity. Now, all of this added together makes up your employee's gross pay. So that is their pay before deductions. And in the UK, you are required to pay your employees at least the national minimum wage. And that for the current year, as of the 1st of April, for employees aged 21 and above is £11.44 per hour. Now, you might not necessarily pay your employees hourly. So if they do get a fixed salary, you do need to ensure that that salary compared to the contracted hours works out at an hourly rate of at least the national minimum wage. So looking specifically at the payments on Harry's payslip here, we have got a fixed salary that he gets paid every month. So that's his annual salary divided by 12 in this example. And then just underneath that, we do have an hourly payment. So the amount of overtime that Harry gets does vary depending on the number of hours overtime that they've worked. So as per that requirement, the number of hours is stated on the payslip, 7.5 in this particular example. We've also got the hourly rate for information, and then the total amount of the overtime payment is part of that employee's gross pay. They also have a third payment line for commission. So this is the amount of commission that has been earned this month. But that fourth line, which I thought I would include here, is a negative payment. And the reason for that is it's a cycle to work deduction, which is actually a salary sacrifice arrangement. So usually on a pay slip, you would find a salary sacrifice in the payment section, denoted with a negative payment value. And a salary sacrifice is essentially an arrangement between an employee and their employer, where the employee agrees to give up part of their salary. So they sacrifice that part of their salary in exchange for a non-cash benefit, such as a pension contribution into their pension scheme. It could be childcare vouchers, although that is less common because the childcare voucher scheme closed to new entrants some time ago. Or it could be more recently things like company cars or the cycle to work scheme as we're using in this example. And the benefit of a salary sacrifice is that the employee makes savings on the tax they would have paid and their national insurance. And there's also a benefit to the employer, as the employer would not pay national insurance on the amount of that salary sacrifice as well. So this is what's making up Harry's gross pay, but what's most important to him is what he's actually taking home. So an employee's net pay is the amount that they would receive after deductions. So also known as take-home pay, because that is the money that'll be paid into their bank, or they would take away in cash if any of you still pay with a cash payment method. The net pay on the payslip is usually pretty prominent. I find it's usually in the bottom right-hand corner. So in this particular image here, you can see the net pay is just under £2,000 for this month. And that is what's left over after all of the deductions that have been taken from the gross pay, which is what we're going to cover in the next section. So gross pay is your payment before tax, national insurance, and other deductions. And your net pay, of course, is the take-home pay. So next on our journey around this payslip, we are going to take a closer look at deductions. And in this section, I'm going to try and explain a bit more about how some of these deductions work. Now, when you run a payroll, obviously you'll be using payroll software. Many of you will be using Sage 50 Payroll or Sage Payroll, our cloud solution. And your payroll software does the work for you. It calculates the deductions, it makes the deductions, and then it works out the net pay for the employee. But it is good to have a bit of background on what all these deductions are about and how those calculations work. And that's what I'm going to attempt to explain in the next section of this webinar. So these are the deductions that are found on Harry's latest payslip, and I've grouped these together into certain categories. So I've got what I'm calling statutory deductions. So these are deductions that are usually made from all employees. So we've got income tax, so pay-as-you-earn tax, national insurance contribution, and if repaying a student loan, the student loan repayment. And we've also grouped pension contributions into this statutory deduction section, because under workplace pensions law, there are certain categories of employees that have to be put into a pension scheme, and then they do have the option of leaving that pension scheme or opting out at their own choice. So statutory deductions will always appear on a payslip. They can vary depending on how the calculation is done, and we're going to look closer at some of those calculations in a few moments' time. I've then got some voluntary deductions. So this is things that the employee has chosen to be deducted from their pay usually. So some examples of voluntary deductions, and there's loads of these that could be in play, is union fees. So if there's a subscription to a union that's taken from the employee's pay, that can be deducted from their pay, and then that subscription is paid over. They might have joined a dental plan that's facilitated by the employer, but not actually paid for by the employer as a benefit. So on my payslip, I have a deduction for dental insurance, so that is deducted after tax and NI. And then there's a third type of deduction that I thought I'd mention, and this is one that you probably wouldn't want on your payslip, but that's an attachment of earnings order. So these can be used for employees to pay child maintenance, unpaid council tax, fines or civil debts. They're usually court-issued documents, and it instructs you as an employer to make a deduction from your employee's pay to pay for any of these items and more. So I do want to look at take you through a closer look at some of the statutory deductions to start with. So we'll have a look at PAYE tax. So PAYE stands for pay as you earn. That first came in, I think, at about 1944. And it just makes paying tax a lot simpler for the vast majority of people who are employees. And the way that a tax calculation works is made up of the personal allowance that everyone gets, and then the various tax bands and rates for the country in the UK that your employee lives. So it is your tax code that will determine how much personal allowance, sometimes known as free pay, is used when calculating tax, because there is a portion of your earnings that you don't have to pay tax on, and then tax is due on earnings above that. Now, the standard personal allowance in the UK is currently £12,570, and it's actually been that level since 2021, when the government froze the personal allowance, as well as the higher rate tax band, for a period of 5 years, which is up to and including 2025 to 26. So that £12,570 results in a tax code of 1257. So you drop the last figure of the personal allowance to give you the number 1257, and often it ends in L, which is the suffix used for employees with kind of pretty standard tax affairs. Now, the personal allowance that you see in there is an annual allowance, as are the tax bands that I will show you in just a moment. but tax is usually calculated on a cumulative basis. So these allowances and tax bands, although they're kind of published as yearly amounts, in practice, they are spread out throughout the year. So in the case of a monthly paid employee, in month 1 of the tax year, they would get 1/12 of their personal allowance and 1/12 of the different tax band limits, and then that would increase to 2/12, 3/12, 4/12 as you go throughout the year. And same principle as well for weekly, although that would then be divided by 52. So that's the kind of tax code and the personal allowance. Next thing just to mention, and I've taken these images from the gov.uk website, are your income tax rates and bands. So there are different rates and bands depending on whether you live in Scotland or not. So if you don't live in Scotland, the income tax rates and bands are a basic rate above your personal allowance of 20%. There's then a higher rate of tax. So earnings above the higher rate band are at 40%. And then there's an additional rate band at 45%. And you can see the earnings that applies to throughout the year. So just to sort of bring that to life with a bit of a graphic, you can see I've got a little cylinder on the right-hand side of the slide that represents an employee's annual earnings. So come the end of the tax year, there'll be a certain amount that they haven't paid tax on. So that's their free pay allowance, it's their personal allowance, usually for people with one job and simple tax affairs at £12,570. They then pay the basic rate of tax on earnings up to £50,270 if they get a standard personal allowance. So that is 20% in England, Wales and Northern Ireland. They then go into the higher rate tax band. So that's a 40% rate of tax on earnings above £50,270, all the way up to £125,140. And then the additional rate of tax, your 45%, is on earnings above that 125,140. In addition to that, if an employee earns more than £100,000 per year, they start to lose their personal allowance. So the personal allowance reduces by £2 for every £1 of extra taxable income until there is no personal allowance if your earnings each year are more than £125,140. And that's usually dealt with a change of tax code. So that's how it works outside of Scotland. If you're a Scottish taxpayer, you will have the letter S at the start of your tax code. And because this legislation is devolved, in Scotland they have a different set of tax bands. So as you can see from the slide there, the graphic at the bottom, there's quite a few of them: starter rate, basic rate, intermediate, higher, advanced and top. And they're all at various different percentages depending on the level of earnings. So I haven't got a fancy graphic for that one. There were just too many tax rates for me to fit in. But you can read more about that following the link to the income tax information on the gov.uk website. So when it comes to it, your employee's tax code must appear on the payslip as well as their payment frequency, which for Harry in our example is monthly. And there'll be ways that they could check the tax that they've paid using their year-to-date values, which we'll come on to a little bit later. So PAYE tax is one of those statutory deductions. The other ones I'm going to mention are national insurance and student loans. So national insurance is something paid by both employees and employers, and it is payable on earnings above the primary threshold for employees and the secondary threshold for employers. So under current legislation, the primary threshold is actually set at the same level as the personal allowance, but this deduction isn't calculated on a cumulative basis. It is calculated per period. So it will use the equivalent monthly or weekly thresholds to calculate how much NI is due in that period. Now, it's an employee's NI category that determines the rates of national insurance that you pay. And the most common national insurance category is category A. That's standard rate contributions. And that applies to most employees who are over 20, so 21 or older, up to state pension age. Other common NI categories include category C, So this is an employer-only contribution, and that applies to employees who have reached state pension age. So they no longer have to pay national insurance. The employer still contributes. Category H is for apprentices under 21. So it's still a standard rate for the employee, but it does provide a bit of a tax break to the employer, as there's no national insurance due on earnings up to the upper earnings limit for apprentices over 25. So a bit of a tax saving for the employer, or an NI saving, I should say. We've got category J, which is deferred contributions. That can be used for employees that have other employment where they already pay national insurance up to the upper earnings limit. And category M is for staff age 16 to 20, standard rate for them. Again, there's NI savings to be had as an employer, as there'll be a 0% contribution on earnings up to the upper earnings limit. So national insurance, the rates for category A have recently decreased. So they are now down to 8% on earnings between primary threshold and upper earnings limit. And then above the upper earnings limit, the national insurance contribution reduces to 2% for the employee. So that one's calculated each period, as are any student or postgraduate loan deductions. So I'm just going to call them student loans. These repayments are made via the pay-as-you-earn system for any employee who started their course since September 1998. And I know that date well. That's actually when I started university. So I would have been one of the first cohorts to start repaying a student loan through the PAYE system. And it's the plan type that determines the repayment threshold when it comes to student loan deductions. So student loan is only deducted if the employee earns above the relevant threshold for their plan type. And you can see the weekly, monthly and annual thresholds, which I've just copied there from our online support guide. Now, if you're unsure what plan type an employee should be on, there are different ways you can find out. One way is to ask your employee, and they can sign into their student loan repayment account on the gov.uk website, which should then confirm to them what plan type they're on. Or if you use the starter checklist from HMRC, that has some good information about what the different plan types are, and that should help you and your employee determine what type of student loan you should be deducting. Or if you get a notification from HMRC to start making student loan deductions, that will, in the notification, tell you what plan type it is. So rates for student loans is 9% of earnings above the threshold. Postgraduate loans, it is 6%. Now, all of those deductions are what I would call pay-as-you-earn deductions, and the amounts that you deduct are paid by the employer to HMRC as part of your monthly payment. Or if you're a very small employer, you might be paying this quarterly. And that information about these deductions is sent to HMRC as part of your payroll submission, your full payment submission. And Alice will actually be covering more on e-submissions with HMRC on Thursday's session, keeping it real-time information. So do join us for that one if you want to learn more about that. So from the PAYE deductions, I'm now moving on to pension contributions. And before I go into this one, a little pop quiz for you. We've got an image of a character in the bottom right-hand corner of the slide there. And I'm wondering if that's familiar to anyone. Do you know who that guy is? Answers on a postcard or in the chat if you'd like to have a guess, and I will tell you who that person is in a few moments' time. But back to pension contributions. There is now workplace pensions law in the UK, known as automatic enrolment, which first came into effect for the largest employers from October 2012, and now applies to all employers within the UK. Now, this duty means that if eligible, employees will need to be put into a pension scheme automatically, and the employer must start making contributions towards that pension. And the criteria to be eligible, as you can see from the slide there, is based on an employee's age and wage. So if an employee is aged between 22 and state pension age, and they earn the equivalent of £10,000 per year, they are classed as an eligible employee, and they need to go into a pension scheme. Once enrolled, they don't have to stay in the scheme. They can choose to opt out, in which case they would get a refund of contributions they've made within the first month. But they do get put back into the scheme every 3 years. And it's really to encourage employees to save for their retirement. And it's a workplace pensions duty on all employers. Now, when pension contributions are deducted from an employee, they do get tax relief on the contribution, but the way that they get that tax relief does depend on how the pension scheme has been set up. So if you have a pension scheme that uses a net pay arrangement for tax relief, it means that you deduct the pension before calculation of tax. So that means that the amount of the pension contribution hasn't been taxed, so they've had tax relief on that amount. Or if your pension scheme operates what's known as a relief at source arrangement, it means that you make a deduction from your employee after tax, and that's actually adjusted down by 20% to account for the basic rate of tax, and then the pension provider reclaims the tax relief directly from HMRC. The other way that people can contribute to a pension is via a salary sacrifice arrangement. So in that case, the amount sacrificed by the employee is added to the employer contribution, and that all goes into the pension scheme, obviously tax-free. So pension contributions must be stated on a payslip. You would see the employee contribution and also the employer contribution. And where you would find that on the payslip really depends on what kind of payslip you're looking at. And you'll see a little bit later on when we look at the full payslip, we've got the pension contribution for Harry stated within that deductions section. So before we move on, who was the little fluffy guy on the bottom right hand corner? Don't know if anyone got this one. His name is Worky. He was a mascot introduced by the Department for Work and Pensions as part of their awareness campaign for automatic enrolment in 2015, which was round about the time when the smaller employers, those with 50 employees or less, staged for auto enrolment. So it was both aimed at employers and employees. Do not ignore the workplace pension, I think was the tagline, and Worky is a kind of physical representation of a workplace pension. So from statutory deductions and pensions onto other types of deduction. Voluntary deductions I kind of mentioned earlier, so this could include union fees. I have dental insurance payments taken from my pay, and this is all taken after tax and national insurance. So you can see there I've got a union subscription on Harry's payslip, and then we've got the attachment of earnings orders. So these are the debt deductions for things like unpaid council tax, fines or civil debts. They can also be used to reclaim overpaid benefits as well. If you ever get a direct earnings attachment, that is often used to reclaim overpaid benefits. So if you're instructed to make that deduction, you'll either be given an amount to deduct, or you'll be given some tables showing you how to work out the amount to deduct. And that again is taken from the employee's pay after tax and NI. So we've covered payments, we've covered deductions. The other area of the payslip we're going to have a quick look at is the year-to-date values. Now, year-to-date values are usually shown on payslips. It's one of the items that isn't technically a requirement. It's not in the list of things that must be on a payslip, but more often than not, you will see them. They show you the values for the tax year to date. So the tax year, which begins on the 6th of April. And it's those year-to-date values that you would typically see on a P60 at the end of each tax year, which is an overall view of your employees' pay and deductions for the full year. It can be really helpful to have year-to-date values on a payslip, as it enables your employees to check tax calculations, maybe using a tax calculator on the gov.uk website, make sure that you are deducting the correct amount from them. But of course, if you've got payroll software doing that for you and it's fully up to date, there should be no problems there. And because they are cumulative figures, it also enables an employee just to check that everything is adding up month by month or week by week, if they ever kind of wanted to do that. So we've got year-to-date values there on the particular, on Harry's payslip. It's up to month 5. In this particular example, we've got both the gross pay, national insurance, tax and pension on the year to dates just there. But as an aside, if you ever wondered, like I have, why the tax year begins on the 6th of April, again, I've done a little bit of research and I have an explanation for you. So this is all to do with leap years and calendars, and the fact that in 1752, the UK switched from the Julian calendar to the Gregorian calendar, named after Pope Gregory XIII, which is the chap there on the image on the slide. And the reason for this was to align our calendar year with the solar year, because we were getting a little bit behind because of the way that leap years were calculated. And when that switch was made by the UK, it did require 11 days to be dropped from the calendar to realign with the rest of Europe and with the solar year. Now, the Treasury, being the Treasury, didn't want to lose any tax revenue, so the story goes. And originally, the tax year did begin on the 25th of March, which again sounds quite random, but that was quite an important date known as Ladies' Day. And the 11 days added to it ended up starting the tax year on April the 5th. Now, about 50 years later, there were some further adjustments made, again, to account for leap years and solar years, and it settled on a start date of the tax year being April the 6th. So you can read more about that explanation, make of it what you will, following the link. So I have cited my source there, but the reason the tax year starts on the 6th of April is all to do with the switch to the calendar, so and the Treasury not wanting to miss out on tax revenue, apparently. So there's another fascinating fact for you. So that concludes the look at the payslip. Hopefully that has given you some insight as to the different information you would see on a payslip, why it's there, and how some of the deductions are calculated. We started this webinar off with the oldest payslip in the world, dating back to about 3200 BC. Let's finish the webinar by looking at the future of payslips. And as I said earlier, the future is here now. And I'm going to give you a quick look through an online payslip powered by Sage HR, which is available if you have Sage 50 Payroll or even Sage Payroll that you log into through a browser. So for this one, I'm just going to switch my camera off for a moment to give you a quick tour around. So I'm going to start with the employees view. We've been looking at Harry's payslip, kind of a printed version of Harry's payslip, but Harry's employer has very wisely decided to host their payslips online because they use a Sage Payroll solution. Their payslips are hosted in Sage HR. So this is the view that Harry gets, and Harry's employer also uses Sage HR for other purposes such as leave tracking and timesheets. So we can see here there's a nice dashboard showing things like leave balances. But the area that we're interested in today is the payslips and P60s, which can be viewed here in the browser by following the link here on the left-hand side. So from here we can see a list of payslips, including historical payslips, going back a number of years in fact. And the one we've been looking at today, 31st of August, is showing in the list, and that can be viewed on screen like so. And we would then see the same information that I've just taken you through. So we've got all the payment details. We've got Harry's deductions. We've got Harry's take-home pay. Got the tax code that was used for the tax, the pay frequency, and we've got all of those year-to-date values as well. So one of the advantages here is that Harry can access his payslips whenever he needs to. If he needs to share them, if he's getting a mortgage or anything like that, he can download them as a PDF. So we can save as PDF. That downloads as more of a traditional payslip view. So it's looking something like this. So that can then be forwarded on or printed as required. As well as the payslips, you can also host your P60s in Sage HR. So this was the P60 for the end of the previous tax year. Again, all the information can be quickly viewed online. So these are the totals for the pay and tax, for the national insurance and any statutory payments. And you've got the full PDF version available as well. So Harry gets an email each time I publish a P60, and if he uses the mobile app, you can also view these from his smartphone. Harry's employer gets to view the admin view. So this is what the admin view of Sage HR is. So I've got a view of all of my different employees within the business. I can go to the main payslips area. So I can access this from any browser as an admin user. You can see all of my payslips for my last pay date, so they can be easily viewed on screen like so. We can download the PDFs if we need to pass them on for any reason. And we've got a view of all of our employees' P60s. So Sage HR can be used for hosting your payslips, many other uses as well, such as our shared calendar here, which tracks things like leave and absence. There's timesheets module and plenty more to discover in the world of Sage HR. So that's just a quick view of the future of payslips, and it is also available on a mobile app. So in the App Store or the Google Play Store, employees can download the Sage HR app. They can sign in with the same details that they use for the web portal, and then they can view their payslips from the mobile app, can download the payslip if they need to. They can share it or save it as they would from a traditional browser. So from the oldest to the newest payslips, that brings us to the end of the presentation today. Just to remind you of our other National Payroll Week webinars taking place, and if you attend 3 of these or more over the week, you will get your digital badge for National Payroll Week 2024. So we've got our Sage HR Advice webinar with our special guests from HR Advice, expert tips and guidance, keeping it real-time information with Alice, parental leave essentials with myself, and me and Alice will be back at the end of the week with our National Payroll Week quiz. Other places you can find support if you do use our Sage payroll software is our help center at sage.co.uk/help. You can just choose the product that you're using, and from there you can search our knowledge base, read support guides, view any webinars that are coming up. So webinars are not just for National Payroll Week, we run them every week throughout the year. So do see what else is coming up this month. You can watch our videos, and if you need to get in touch with our support team, if you need help with your Sage product, there are Get in Touch links if you click to the topic that you need help with. If you're interested in learning more about the fundamentals of payroll, we do have a great payroll fundamentals course available on Sage University. That is free for you to access. You just need to create a profile at sageu.com and find your way to the Sage 50 Payroll or Sage Payroll Learning Path, where you'll find that course that you can then dip in and out of to improve and enhance your payroll knowledge. With that said, we are now at the end of the time. So thanks so much once again, everyone, for joining us. Thanks to Alice, Matthew and Matt for taking the questions there in the question section. Have a great rest of your day, and we look forward to seeing you on some of our other National Payroll Week webinars between now and Friday. But for now, it's goodbye from me. We'll see you on the next one.